Welcome to the Inspired Podcast. What if Warren Buffett's mentor, wrote like the ultimate guide to surviving stock market chaos? I
Yeah.
think that'd be pretty interesting to read, right?
Yeah.
Let's dive into the book Buffett calls the best investing book ever written. Today we're taking a deep dive into Benjamin Graham's The Intelligent Investor. You shared your curiosity about understanding those like core investing principles, right?
Right.
And this book is foundational. Our mission is to unpack its key ideas so you can navigate the market with greater confidence and avoid feeling overwhelmed by its volatility.
Yeah.
We'll look at what makes this book so influential and how its like decades-old wisdom still applies today. Okay, let's unpack this. What were the pivotal experiences that shaped Benjamin Graham's thinking and ultimately led him to write this investment Bible?
Well, the genesis of Graham's profound insights really stems from a tumultuous early career. He achieved considerable success on Wall Street, building a comfortable fortune. But then the catastrophic stock market crash of 1929 and the ensuing Great Depression struck a devastating blow, wiping out a significant portion of his wealth.
Wow.
Now, instead of succumbing to despair, what's fascinating here is how Graham meticulously dissected those events. He was determined to understand exactly what went wrong, and this deep analysis led him to a core principle: the absolute necessity of minimizing downside risk. His fundamental aim became buying assets at a substantial discount, the well-known idea of trying to pay 50 cents for a dollar's worth of intrinsic value.
Right.
This wasn't just a theory, it was a lesson etched in the pain of personal financial loss.
So that core idea of buying low wasn't just some abstract concept. It was forged in the fires of a real financial disaster.
Right.
And it was this experience that propelled him to write his first major work, Security Analysis, right?
Precisely. Security Analysis, published in 1934 and co-authored with David Dodd, laid the intellectual foundation for the intelligent investor. If we connect this to the bigger picture, Security Analysis was a much more rigorous and comprehensive exploration of investment theory. A truly pivotal contribution was Graham's sharp distinction between investment and speculation. In his view, genuine investment after thorough investigation offers the safety of your initial capital and a reasonable expectation of return. Anything that doesn't meet those criteria, that's speculation, plain and simple.
Right.
This might seem obvious now, but back then the lines were often incredibly blurred, with many people engaging in what was essentially gambling disguised as investing.
Makes sense. It wasn't about trying to get rich quick.
Yeah.
It was about a much more fundamental, almost business-like approach to growing wealth while protecting what you have.
Right.
I recall reading something about his very specific way of viewing stock ownership.
Yes, that's a cornerstone of his philosophy. Graham passionately advocated for viewing the purchase of stock not as simply trading a piece of paper, but as acquiring a fractional ownership in a real operating business. This fundamental shift in perspective changes everything. He famously used a powerful analogy. Think of the stock market as a short-term voting machine where stock prices can fluctuate wildly based on fleeting popularity and market sentiment.
Okay.
But in the long run, it acts as a weighing machine, where a company's true underlying value will eventually be reflected in its stock price. Security Analysis heavily emphasized the critical need to thoroughly analyze the actual business behind the stock, its assets, its earning potential, its management, to identify those undervalued opportunities that the short-term voting machine might be temporarily mispricing.
Fascinating. So Security Analysis was the deep academic dive into the why and how of value.
Right.
And then the intelligent investor followed later, building upon those core principles, but perhaps tailored for a wider audience.
Exactly. The Intelligent Investor, which came out in 1949, took the core tenets of value investing that Graham had been teaching at Columbia Business School since 1928, this central idea of focusing on intrinsic worth, and presented them in a more accessible and practical manner for the average investor. While Security Analysis was more of a detailed textbook for investment professionals, the Intelligent Investor concentrated on the practical application of these principles, and crucially, the psychological discipline required to be a successful long-term investor.
Interesting. And one of the most enduring and memorable concepts from The Intelligent Investor has to be the allegory of Mr. Market. Can you break that down for us and highlight the key insight?
The tale of Mr. Market is truly one of Graham's most brilliant and enduring contributions. Imagine this imaginary business partner who shows up at your door every single day, offering to either buy your shares or sell you his shares in the business. Now, here's the crucial part. Mr. Market's pricing is incredibly erratic. Sometimes his offers are rationally based on the actual performance of the company and the state of the economy, but much of the time, his prices are driven by pure emotion. waves of irrational optimism or deep unwarranted pessimism, reflecting the collective mood swings of the market participants.
So the core insight here is to treat the market's daily move swings like noise and focus on the underlying value.
Right.
Don't let fear or greed dictate your long-term decisions.
Absolutely.
And this leads us directly into the heart of Graham's investment philosophy, value investing. What are the fundamental elements of that approach?
At its core, value investing is about diligently determining the intrinsic value of a stock, what a company is genuinely worth, completely independent of its current trading price in the market. This requires a deep and thorough analysis of the company's fundamental strengths, its assets, its ability to generate earnings, and its dividend payouts. The central aim is to identify situations where the prevailing market price is significantly lower than this carefully calculated intrinsic value. When you discover such an undervaluation, you make your move to buy, essentially purchasing a dollar's worth of real value for significantly less than a dollar. The underlying strategy, then, is to patiently hold on to that investment until the market eventually recognizes its true worth, a phenomenon known as mean reversion. This idea of mean reversion simply means that over time, a stock's price is likely to move back towards its intrinsic value.
So essentially, you're buying when the market is undervaluing the asset and waiting for it to correct.
Exactly.
And Graham even developed specific, almost formulaic techniques for identifying these undervalued situations, such as the net-net value approach.
Yes, the net-net value technique was one of Graham's more deep value, almost surgical strategies. It involves valuing a company based purely on its net current assets. That is, its most liquid assets minus all of its total liabilities. Graham was known for seeking out and buying stocks that were trading at a substantial discount to this net value, often aiming for a price around 2/3 of it. This provided a very significant margin of safety because even if the company were to liquidate, its readily convertible assets would likely cover your investment and then some.
So you're essentially looking for companies that are so cheap that even if they went out of business tomorrow,
Yeah.
you'd still come out ahead.
Yes, in theory.
Wow, margin of safety. That's a phrase that's practically synonymous with Graham's name.
It is.
Why was it such a central and non-negotiable element of his investment thinking?
You've hit the nail on the head. The margin of safety was absolutely paramount for Graham. It wasn't just a desirable add-on. It was the very bedrock of his investment philosophy. Think of it as your essential insurance policy. It protects you against potential errors in your own analysis, unexpected negative developments within the company or the broader economic landscape, and the inherent unpredictability that characterizes the market. Buying at a price significantly below your calculated intrinsic value is the primary way to establish this crucial buffer. As we discussed with the net-net strategy, the wider the gap between the price you pay and the underlying fundamental value, the greater and more robust your margin of safety becomes. It provides a critical cushion, minimizing the risk of substantial losses.
Margin of safety isn't just about buying cheap. It's your insurance against being wrong, plain and simple.
Exactly.
And he didn't rely solely on buying at a discount to achieve this buffer, did he?
Hmm.
He also advocated for other complementary strategies to enhance that margin of safety.
Absolutely. Diversification across a range of different sectors and asset classes is another key method Graham championed for enhancing your margin of safety.
Makes sense.
By not putting all your eggs in one basket, you reduce the impact of any single investment performing poorly. Investing in well-established companies with a consistent track record of paying high dividend yields was another strategy he favored. Dividends provide a tangible return on your investment and can also be an indicator of a company's financial strength and stability. Furthermore, Graham generally preferred companies with conservative financial structures, meaning low levels of debt relative to their equity.
Yeah.
Excessive debt can significantly amplify financial risks, particularly during economic downturns, eroding your margin of safety.
It's all about minimizing that downside risk.
Yes.
Now, being the rigorously analytical thinker that he was, Graham even developed quantitative formulas as tools to help investors estimate a stock's intrinsic value, didn't he?
He certainly did. The original Benjamin Graham formula was designed to provide a quantitative framework for estimating a stock's inherent worth. It took into account the company's earnings per share, EPS, and its anticipated long-term growth rate. The initial formula was expressed as V equals EPS times 8.5 plus 2G, where 8.5 represented the price-to-earnings PE ratio of a no-growth company, and G stood for the expected long-term growth rate. later on recognizing the significant influence of prevailing interest rates on investment valuations.
Okay.
Graham revised the formula to incorporate the risk-free rate of return, which he used the yield on high-grade corporate bonds as a proxy for. The revised formula became V equals EPS times 8.5 plus 2G times 4.4 divided by Y, where Y represented the current yield on AAA corporate bonds in 1962, which he used as a benchmark for the risk-free rate.
So the formula's attempt to take into account both the company's growth potential and the prevailing interest rate environment
Yes.
to arrive at a more accurate estimate of intrinsic value.
Exactly.
It's fascinating to see how he attempted to bring a degree of mathematical precision to this somewhat elusive concept of value. And he also had a clear and strong preference for investing in companies that consistently paid dividends to their shareholders, correct?
Yes. Graham was a staunch advocate for companies that regularly distributed a portion of their profits to shareholders in the form of dividends. He viewed these dividends not just as a tangible return on investment that investors could rely on, but also as a signal of a mature, profitable, and financially disciplined business.
So dividends were a sign of a company's financial strength and commitment to returning value to its shareholders.
Exactly.
Now, it's impossible to discuss Benjamin Graham and the intelligent investor without touching upon his most celebrated student and protege, Warren Buffett. Their intellectual connection and personal relationship are truly legendary in the world of finance.
Absolutely. Warren Buffett himself has famously declared The Intelligent Investor to be by far the best book on investing ever written. This wasn't just a passing compliment. Buffett credits his early reading of Graham's masterpiece at the young age of 19, with fundamentally shaping his entire investment philosophy and career trajectory. So profoundly was he influenced that Buffett made the deliberate decision to enroll in Columbia Business School, specifically to have the opportunity to study directly under Graham. Their relationship blossomed beyond the academic setting. They forged a deep and enduring lifelong friendship. And Buffett even worked for Graham at his investment company, the Graham-Newman Corp., until Graham's eventual retirement.
So the Oracle of Omaha himself owes much of his success to the principles he learned from Benjamin Graham.
He does.
And it's abundantly clear that those core principles he learned from Graham truly stuck with Buffett throughout his remarkable career. The concept of a margin of safety, for instance, seems to be an absolutely foundational element of Buffett's investment approach as well.
Undeniably. While Graham's students, including Buffett, have certainly evolved and developed their own unique investment styles and areas of emphasis over time, the fundamental principle of diligently seeking out and establishing a significant margin of safety remains a common and unwavering thread that runs through all of them. Buffett, much like Graham, maintains a sharp focus on purchasing securities. Only when their prevailing market prices appear unjustifiably low in relation to their underlying intrinsic worth.
Okay.
He also places a significant emphasis on other crucial factors, such as the quality of a company's business operations, its level of debt, and its consistent profitability and healthy profit margins.
So for both of them, it's not just about buying cheap, it's about buying good businesses at a discount.
Exactly.
But while their core philosophies align,
Yeah.
there are some notable differences and their practical approaches aren't there. My understanding is that Buffett tends to place a greater emphasis on the quality and long-term durability of a business, often with a much longer holding period in mind.
That's a very astute observation and a key distinction between their specific investment styles. While both are firmly rooted in the principles of value investing, Buffett places a considerably greater emphasis on the long-term quality and enduring competitive advantages, what he calls economic moats of a business. He advocates for buying shares in these exceptional companies with the intention of holding them for very extended periods, in some cases virtually indefinitely, as long as the business fundamentals remain strong. Graham's approach, while deeply focused on identifying undervalued situations, could sometimes involve purchasing shares in fundamentally sound but perhaps less exceptional companies, with the primary expectation that their price would eventually revert to their net asset value or intrinsic worth within a shorter time frame, at which point he might sell. Buffett's focus is more on owning truly outstanding businesses capable of consistently generating strong earnings over many decades, and he is often less concerned with short-term market recognition of their inherent value.
So Buffett is playing the long game, looking for companies that can compound their value over decades.
Right.
While Graham was more focused on finding those shorter-term opportunities where the market was mispricing a company's assets.
That's a good way to put it.
However, it's worth remembering that Buffett himself has stated unequivocally that no one who consistently followed Graham's core investment methods ever lost money over the long run.
A very powerful endorsement.
So for someone picking up The Intelligent Investor, for the first time today in our current market environment. What are the absolutely essential key lessons and actionable insights they should be taking away from Graham's timeless wisdom?
Well, the book offers an incredibly rich trove of enduring principles. Firstly, it teaches you to cultivate a business-like mindset when approaching the stock market,
Okay.
emphasizing the need to thoroughly analyze a company's underlying financial health and its operational performance, while consciously disregarding the often irrational emotional noise and the daily price fluctuations that are driven by fleeting investor sentiment.
So essentially be rational and focus on the fundamentals, not the noise.
Precisely.
And what else?
Secondly, it powerfully underscores the critical importance of diligently identifying those situations where a significant discrepancy exists between a stock's current market price and your own well-researched assessment of its intrinsic value. The actionable advice is clear. Act decisively when the market is offering a bargain buy, when the price is substantially below your calculated intrinsic worth. And consider selling when the market price has risen to align with or even exceed that intrinsic value.
Buy low, sell high.
In essence.
Yes, and the book also provides practical guidance on how an individual investor should structure and manage their investment portfolio, doesn't it?
Yes, Graham offered concrete advice on asset allocation, suggesting a fundamental starting point of a 50% allocation to high-quality stocks
Okay.
and 50% to high-grade bonds or cash equivalents, with the flexibility to adjust these percentages based on your individual financial circumstances, your personal risk tolerance, and prevailing market conditions.
So a balanced approach tailored to the individual investor.
Right.
What else?
He issued strong warnings against the inherent dangers of speculative activities such as day trading and attempting to time the unpredictable swings of the market. Instead, he advocated for patiently taking advantage of market volatility as potential opportunities to acquire undervalued assets when others are panicking,
Okay.
and to consistently avoid getting swept up in the allure of fashionable or heavily hyped up stocks with little underlying fundamental value.
Don't follow the herd.
Exactly.
Right.
Finally, he stressed the crucial need for investors to be constantly vigilant and to critically examine how companies might be employing various accounting methods to potentially inflate their reported earnings or obscure their true financial picture.
So always be skeptical and do your own due diligence.
Always.
Considering that The Intelligent Investor was originally published over 7 decades ago, how remarkably relevant and applicable are its core principles in today's rapidly evolving and often technologically driven financial markets?
The fundamental principles articulated in The Intelligent Investor remain astonishingly relevant and powerful even in today's dynamic markets.
Really?
The core advice to always invest with a significant margin of safety is perhaps even more critical. In our current environment of rapid technological change and global interconnectedness, which can introduce new and unforeseen risks, the imperative to conduct thorough and independent research and to fully understand the businesses you are investing in before committing your capital is absolutely timeless and will never become obsolete.
It seems like common sense, but so many investors get caught up in the hype and forget the basics.
They do.
So you're saying these principles are just as relevant today as they were back then?
Absolutely.
For individuals who are new to the world of investing, the book provides an invaluable and enduring foundation.
In sound long-term investing principles, even though it doesn't delve into the specifics of short-term trading strategies or the nuances of modern financial instruments. Despite the passage of over 70 years, the fundamental human emotions of fear and greed continue to be the primary drivers of market cycles and investor behavior, making Graham's profound psychological insights into investor behavior just as pertinent and insightful today as they were in the mid-20th century.
So human nature hasn't changed, and neither have the basic principles of sound investing.
Exactly.
So when we talk about putting these intelligent investing principles into real-world practice, what does that actually look like for an individual investor?
Intelligent investing, as Graham conceived it and as it remains relevant today, essentially rests upon two indispensable pillars: meticulous and diligent valuation and unwavering patience. You must be willing to dedicate the time and effort required to thoroughly research a company in order to determine its true underlying intrinsic worth. This involves carefully analyzing its financial statements, gaining a deep understanding of its business model and competitive landscape, and assessing the quality of its management. Once you have identified a company whose stock is trading at a significant discount to your calculated intrinsic value, and you have purchased its shares, the second crucial element comes into play. You must possess the patience and discipline to wait, sometimes for an extended period, for the market to eventually recognize that undervaluation and for the stock price to correct accordingly.
So it's not just about finding the right companies, it's also about having the temperament to stick with your investments.
Absolutely.
And that core concept of the margin of safety continues to be the absolute bedrock and the non-negotiable foundation of this entire investment approach.
Absolutely. The margin of safety is not merely a desirable attribute or a secondary consideration in Graham's framework. For him, it was without question the very cornerstone upon which all successful and prudent investing must be built. It provides a vital and indispensable buffer safeguarding your investments, even if your initial analysis proves to be imperfect, or if the underlying business encounters unexpected and adverse difficulties down the line. It represents the critical difference between potentially suffering substantial and permanent losses and having a resilient cushion to absorb unforeseen setbacks and navigate turbulent market conditions.
So the margin of safety is what allows you to sleep well at night, knowing that even if things don't go perfectly according to plan,
Exactly.
you have a built-in buffer to protect your capital.
Precisely.
It's noteworthy that Graham himself reportedly achieved an impressive average annual investment return.
Of approximately 20% over his decades of managing money using these very principles, powerfully demonstrating the long-term efficacy of his methodology. His profound influence even extended to the realm of regulatory reform as he played a significant role in shaping the Securities Act of 1933, underscoring his deep commitment to investor protection and financial market transparency.
It's always valuable to consider different perspectives. I came across an interesting viewpoint that suggested the intelligent investor, with its emphasis on avoiding speculation and focusing on fundamental value, could almost be interpreted as a comprehensive how not to invest guide for those prone to impulsive or emotionally driven trading.
Yeah.
What are your thoughts on that interpretation?
That's a very insightful and thought-provoking way to look at it. In many significant respects, Graham's seminal work does indeed serve as a powerful and enduring antidote to the speculative urges and herd mentality that frequently grip the financial markets. His principles instill a deep and healthy skepticism towards the vast majority of fleeting investment advice, particularly the constant stream of noise and recommendations churned out by what could be aptly termed the financial infotainment complex.
So it's a guide on how to avoid the pitfalls of emotional investing and focus on a more rational and disciplined approach.
Precisely.
And what else?
Graham's core tenets strongly emphasize adopting a rational pricing approach over a futile attempt at market timing in volatile conditions, rather than trying to predict the unpredictable short-term swings of the market. The intelligent investor focuses on diligently buying when the price is demonstrably right, based on a thorough understanding of the underlying intrinsic value of the business.
So it's about being patient and waiting for the right opportunities.
Exactly.
Not trying to outsmart the market.
Right.
So it's fundamentally about adopting the mindset of a part owner of a business, rather than simply behaving like a short-term gambler in the market.
Precisely. Graham consistently urged investors to cultivate the perspective of being part owners of the businesses they choose to invest in, with the corresponding expectation of being treated responsibly and transparently by the company's management.
That's a powerful mental shift.
It is.
And what else?
He vehemently stressed the importance of maintaining a business-like and rational approach to all investment practices, making decisions based on logic, rigorous analysis, and objective data, rather than succumbing to fleeting emotions, unsubstantiated rumors, or the fear of missing out.
Okay.
Competent and successful investing, in his considered view, demands consistent hard work, diligent research, and a commitment to intellectual honesty, a stark contrast to the siren call of get-rich-quick schemes and effortless profits that are so often promoted.
So investing is a serious business.
It is.
And it requires a disciplined and thoughtful approach.
Precisely.
And for individuals who find this intensive level of fundamental analysis to be somewhat daunting or time-consuming, what practical advice would Graham likely offer as an alternative path to intelligent investing?
Graham, being a pragmatist, fully recognized that not every individual investor possesses the time, the inclination, or the deep financial expertise to become a dedicated, deep-value investor. His often suggested alternative for such individuals was to seriously consider engaging a competent, trustworthy, and ethically grounded financial advisor.
Okay.
However, his key expectation was that such an advisor would primarily focus on employing prudent investment strategies, aimed at achieving consistent market-level returns over the long term, rather than attempting to engage in high-risk active trading strategies with the elusive goal of consistently beating the market.
So find a good advisor who's not trying to chase those unrealistic returns.
Exactly.
So,
He viewed the inevitable volatility of the market not as an inherent threat to be feared, but rather as a potential source of opportunities to acquire fundamentally sound assets at temporarily depressed prices.
so don't panic when the market goes down. See it as a chance to buy good companies at a discount.
Precisely.
Right.
For those who might enjoy the excitement of individual stock picking as a recreational hobby, he suggested allocating only a relatively small portion of their total investment capital to such endeavors, while allocating the substantial majority of their funds to low-cost, broadly diversified, passive investment vehicles that align with their individual risk tolerance and long-term financial goals.
So essentially a core and explorer approach with a solid core of diversified index funds and a smaller allocation for individual stock picking if that's something you enjoy.
Exactly.
That's a very balanced and realistic perspective for the average investor. The article also briefly touched upon the enduring trade-off between the benefits of broad diversification and the potential for more concentrated equity holdings to generate potentially outsized wealth. What was Graham's general stance on this spectrum for the typical intelligent investor?
Yes, for the defensive investor, the average individual primarily focused on preserving capital and achieving steady long-term growth without excessive risk, broad diversification across a sufficiently large number of carefully selected, and fundamentally sound securities is a cornerstone of Graham's safety-first approach. However, it is indeed true that many individuals who have amassed extraordinary wealth have often done so through concentrated ownership in a particularly successful business venture.
So diversification is important for managing risk, but concentrated bets can lead to huge rewards if you get it right.
Yes, but it's a much higher risk approach. Graham's principles, as outlined in The Intelligent Investor, are primarily tailored to the needs and risk tolerance of the average investor, where diversification plays a crucial role in mitigating unsystematic risk, the risk associated with individual companies or specific industries.
Right.
The essential point is for each investor to honestly assess their own circumstances, their level of investment knowledge and expertise, and their individual appetite for risk.
So know yourself and invest accordingly. Ultimately, the enduring core message of The Intelligent Investor is that the fundamental principles of sound financial advice, centered on the concepts of intrinsic value and rigorous risk management, have not fundamentally changed in their essence over the many decades since the book's initial publication, which is precisely why Graham's wisdom continues to hold such significant relevance for investors today.
It's timeless wisdom.
It's truly fascinating to contemplate how modern technological advancements, particularly in the realm of artificial intelligence, might intersect with and potentially enhance the application of Graham's timeless investing principles in today's markets. In what specific ways could AI potentially assist the intelligent investor?
What's particularly compelling is the potential for AI to significantly enhance the efficiency and scale at which investors can apply Graham's core ideas. For example, sophisticated AI algorithms are now capable of rapidly and efficiently screening vast universes of publicly traded stocks to identify companies that meet Graham's specific quantitative criteria. For a strong margin of safety, such as those exhibiting exceptionally low price-to-earnings ratios,
High dividend yields relative to their